Hi. Have you ever laid awake at night worrying about the stock market? Especially if you're nearing or in retirement, it can feel a bit scary. We understand. Market swings can make us all feel a little shaky and unsure. But what if we could equip ourselves with some key metrics to make those ups and downs a bit more manageable? Let's talk about a few. It's important to remember that risk and volatility, though they're often lumped together, are not the same thing. Volatility can only provide an indication of risk. The hardest thing to do as investors is to take something measurable and tangible like volatility and translate it into a feeling of tolerability for the price swings that we will encounter. Now, that's a deeper conversation. We'll talk about that later. But for right now, the question is simply this: how do we know what kind of volatility is appropriate and expected for any given investment? Well, we look at some trusted tools to measure and manage volatility to help keep your portfolio steady and your worries at bay. Now, these tools might sound a little weird, but they're not to us. They're fairly common. Let's take standard deviation, for instance. Think of it like you're tracking your heartbeat or your blood pressure, but instead, you're looking at your investment's monthly returns and how much they fluctuate around an average. Knowing this helps you assess what's normal for an investment. Another tool might be the Sharpe ratio. This helps us evaluate if the volatility bumps you experience are justified and worth the returns that you're aiming for. Because let's be honest, if an investment indicates a great return, but you don't have the stomach for some gut-wrenching moves in it, you're probably going to jump ship. It might not be worth it. Another metric could be the Ulcer Index. It zeroes in on downside risk rather than just overall volatility. And this can be especially useful if you're trying to participate in the market's growth, but the thought of downside risk makes you, lay in bed at night. These are just a few examples, but one key to a good night's sleep is using a whole suite of tools to find that true balance of return and volatility that feels right for you. So ask yourself, do you want to manage your money or do you want it to manage you?